Imagine a scenario where big banks might dodge hefty tax hikes in a crucial government budget. It's a decision that's got investors cheering and critics fuming. What if I told you this could reshape how our economy grows, or even spark debates on fairness? Let's dive into the details of why UK banks seem poised to sidestep Rachel Reeves's budget surprises this month. But here's where it gets controversial. Reports reveal the Chancellor has opted not to hike taxes on banks, a move that drove up shares on London's FTSE 100. Take NatWest, for instance. Its stock jumped 2.5%, while Lloyds climbed 2.3%, making them standout performers in a sea of market fluctuations. This decision, according to the Financial Times, stems from Reeves's desire to keep the UK banking sector competitive, fostering economic growth without additional burdens. To put this in perspective for beginners, banks currently face a corporation tax rate of 28%, which breaks down to the standard 25% plus an extra 3% surcharge. It's like a tiered system designed to ensure companies contribute fairly to the nation's coffers. Yet, amid all this, fresh demands for a tax raid on lenders have emerged, pushing the boundaries of what's fair. And this is the part most people miss. Back in August, the Institute for Public Policy Research think tank released a paper estimating that taxing big banks' windfalls from quantitative easing, QE, that emergency strategy the Bank of England rolled out after the 2008 financial crisis to pump money into the economy and stabilize markets, could generate up to £8 billion, QE, in simple terms, involved the central bank buying government bonds to lower interest rates and boost spending, which inadvertently helped banks profit more. The think tank argues Reeves should impose a new levy to claw back these unintended gains, ensuring the public benefits from post-crisis policies. This isn't isolated either. Reeves has been exploring other tax options to address a public finance gap, like tweaks to property taxes or landlords' rental income. For example, think of how council tax or stamp duty changes could affect everyday homeowners or investors. Meanwhile, Treasury insiders were reportedly probing the profits of major UK banks linked to QE, and rumours of a windfall tax triggered a steep drop in banking shares, prompting intense lobbying from the industry. Adding fuel to the fire, UK Finance's October report highlighted that UK banks pay a higher total tax rate than counterparts in places like New York, Dublin, Frankfurt, and Amsterdam, partly due to recent tweaks in employers' national insurance contributions. PwC's estimates paint a vivid picture. In the latest financial year, the sector contributed £43.3 billion in taxes, about 4.3% of all UK government receipts, and that's up a third from £33.4 billion in 2014. It's a reminder of how vital the banking industry is to the economy, yet it raises eyebrows about whether they're shouldering enough. The CEO of NatWest Group, Paul Thwaite, recently cautioned against upping bank taxes, especially as the lender reported a 30% profit surge. He emphasized balancing government needs with policies that promote stability and growth, warning that higher taxes could deter international investors eyeing UK opportunities. Equity analyst Gary Greenwood from Shore Capital chimed in with a thought-provoking twist: to earn a tax reprieve, banks should commit to accelerating economic support, growing faster, not just pocketing gains from rising interest rates through dividends and share buybacks. Is this a fair bargain, or does it let banks off the hook too easily? This decision by Reeves underscores a heated debate. Should banks, flush with crisis-era perks, pay more to help bridge fiscal gaps, or must they stay tax-light to fuel competitiveness? On one side, critics see it as banks profiting unfairly at taxpayers' expense. On the other, it's argued that taxing them could stifle growth and innovation. What do you think? Does this choice prioritize long-term prosperity over short-term fairness, or vice versa? Share your views in the comments. I'd love to hear if you agree with the Chancellor's approach or if you'd push for that windfall tax. Could this be the tipping point for how we balance corporate profits with public needs? Let's discuss.